In terms of today's agenda, if I get that quicker, it's very straightforward. We will be talking about current approaches, and so what I mean by that is each of the panelists will have a few minutes to talk about what they're working on and how they're approaching non-fiat stablecoins or just this space in general. The second topic of conversation is we're going to be talking about the current and future regulatory environment for these approaches. And last but not least, we'll also be talking about possible market adoption for non-fiat stablecoins. So I'm really excited to have this substantive discussion. So if we can give all of our panelists a round of applause, I'd really appreciate that. Okay, awesome. So we're going to start just down a line, and everybody has a chance to just introduce yourself as well as what you're working on, and spend some time talking about your approach and how you're thinking about this space. Thank you.
Sure. My name is Richard. I'm a co-founder of International Stable Currency. We're basically trying to do private money that is not pegged to fiat currency. We're pegged to a basket of financial assets, kind of a gold standard 2.0, where we have more asset than just gold available now to peg our currency, and then that's what we're doing. We're trying to decentralize this process as much as possible, and yeah.
But can you explain a little bit about how it works?
Sure. That's story. So basically, we're pegged to a basket of global stock, global bonds, short-term treasury, gold, and cash. And we maintain the peg through secondary market forces. But essentially what we do is we issue a loan to different reserves that are decentralized, and they maintain the peg by when they sell the token, they implement the reserve. And if the peg goes up and down, they have an arbitrage opportunity. And we can also step in and recalling the loan if the peg drops below that. Is that detailed enough? I don't want to lose everyone. It's quite...
No, that was pretty good. I've asked him questions about how it works. Let me say a little bit more about it, because I think it's really cool. So, like, ordinarily you might think of an issuer of a currency that's backing it with something. You know, we're used to this model like USDC and all these dollar-pegged stablecoins, where it's like you send them money, they hold all of those assets, and they give out coins. So there's one issuer holding all the value, and then you can come back to them with the token, and then you get whatever the value is in the redemption process. But the model, if I understand it, please correct me if I'm wrong here, is a little bit different, where rather than one entity holding all the assets, you have many different entities that can hold the assets. They're called reserves. And then there's this central entity that's almost, it's like a little bit like a central bank. There's this one entity that can actually mint the token itself. And so these other reserve entities, they can borrow the token when it's newly minted and sell it into the market. And then they're the ones holding the reserves. But then now they have debt. They have to eventually repay that debt back to this sort of central bank entity that was the one that minted the token. And that debt is denominated not in dollars, but is denominated in terms of the value of this portfolio that they then have to hold in order to make sure that they can repay that debt later, right? Because if they just held dollars and the value of this portfolio goes up, then they would not have enough money to repay their debt. So they are incentivized by the fact that their debt is denominated in this diversified portfolio of assets to hold that diversified portfolio of assets, and thus you get this sort of semi-decentralized sort of asset backing model. Did I get that right?
We did follow a reserve for a lot of inspiration, so that kind of makes sense why you kind of get it 100%.
Well, it's different, and it's different from what we're doing. It's really cool. Anyway, so yeah, so I mean, I think it's so cool that you know, the way you put it, of like, you know, there was this gold standard where we had this one asset gold, and it's like, well, wait a minute. These days, there's all these different assets, and I'll get to myself in reserve in a second here, because the thing is, like, these days, people already hold their wealth in a portfolio of different assets, right? If you ever try a portfolio, it's not just gold, it's not just dollars, it's, you know, some real estate, some stocks, some bonds, you know, whatever else. Like, that is actually the de facto main store of value for the world today, not fiat currencies. So in a way, the world has already made the transition, but we haven't done that in a monetary sense. We haven't like monetized that type of asset portfolio and then started just using that as money. Instead, we trade back into fiat currencies to do our business. But I think it's so cool to this idea of like, can we just monetize the thing that we already use as a store of value and just turn that into a medium of exchange and unit of account itself, rather than having to switch back and forth all the time, which is what we all spend our lives doing. So anyway, so Reserve is just a different approach to achieve that same end. So Reserve has created this protocol that just allows anyone to create a token on Ethereum that is issuable and redeemable one for one, kind of going back more like the USDC model, where it's like one central entity holding the collateral, but it's on chain. So it's just a smart contract can hold whatever basket of assets the creator of one of these tokens defines. And Reserve is just this underlying framework. So anyone can use the Reserve framework to create what's called an R token, which is then sort of this, it can be kind of thought of as a currency that's issuable and redeemable for whatever that basket is. And so these days, because all of the world's assets are not tokenized, the Reserve protocol is really only usable for like making interesting baskets of like DeFi assets. So these days people have baskets of like C tokens and A tokens and, you know, Curve tokens and Flux F tokens have been added, and like you can play around with all sorts of different things like that. You can try to beat inflation by earning yield and that sort of thing. Eventually we want it to be portfolios of, you know, stocks and bonds and gold and real estate and all sorts of things that ISC are already put in their baskets. So that's what Reserve is.
Stefan, I'm founder of Truflation, and we've launched Nuon, which is a flat coin. I've been in crypto for over a decade. I spent, as the CEO of Bitcoin.com, a lot of my career trying to build a peer-to-peer electronic payment ecosystem. So we got 20 million wallets. We built 500,000 merchants worldwide where you could actually go and pay and purchase products with your crypto assets. We very quickly realized, though, that people didn't want to spend their Bitcoin Cash, or their Ethereum to buy pizza. You don't want to be the guy that spent 10,000 Bitcoin buying a pizza. That was done before. That created the market and helped create the market. And people wanted stablecoins. But we were running a lot of our transactions on top of the Bitcoin Cash blockchain. And while super cheap, super fast, we didn't have a stablecoin. Then the governments decided to shut down economies, shut down travel. We couldn't do commerce anymore. And then we're telling us, don't worry about inflation, don't worry about it, we got you covered, there will be no inflation. Oops, oops, no, it'll be transitory. And then we got to where we are today. So I looked under the carpet, we saw how old it was, and it's a century old. The process they do it manually. They track 60,000 items on a panel basis, and they do it monthly. We wanted to do it daily, census-based, API-fed, led.
And you're talking about the process for measuring inflation.
For measuring the cost of inflation. And we were doing this at the time when Terra was just taking off. So algorithmic stablecoins, indigenous algorithmic stablecoins using their own token as collateral. And so as we were scaling up, Terra blew up, so we had to change. Balaji and Chainlink or Sergey put out a competition. Who's got an inflation dashboard? Because they didn't believe it either. And so we said, we've already done it. We built the back end. Let's just do a nice front end. And that has got Truflation as a source of truth for how the economy is performing through the metric inflation. We now have 12 subcategories. We have some 50 categories under each of those categories, and we're getting more and more granular as we go on. But what we still were really passionate about was building this flat coin. Why? Because we lose 15%. Over the last 2 years, anybody holding US dollars has lost 15% in purchasing power, according to Truflation. So how do we leverage Truflation as the true source of inflation metrics to be able to retain and not be hit by this hidden tax? And that's what we really built out. We launched it about a month ago, so it's super young. We're still learning, so we partner, and hopefully maybe we will be announcing partnerships with ISC, with Reserve, and maybe a couple of other stablecoins to really sort of grow the need for decentralized flat coins or inflation protected or inflation beating stablecoins.
I think that's a really great explanation of the why for not only Truflation but also Nuon. Could you expand a little bit more about the Nuon protocol and how it works?
So basically, in simple terms, think of your US dollar plus minus Truflation as the peg. That is how we calculate the peg. And that peg is sourced from Truflation. Truflation provides that price feed. at a premium, and it's hosted by Chainlink nodes and node operators. So it is decentralized from a feed perspective, number one. Number two is the incentivization is through arbitrage, obviously. When the price is above the peg, people want to sell it into the market, mint it, and then sell it into the market, and vice versa if it's below the peg. That's sort of the general principle of how it works. Obviously, it's over collateralized, and we only use digital assets as collateral. So we don't use stable coins. We use Ethereum, wrapped Ethereum, linked staked LSDs, and then Arbitrum and Chainlink.
Okay, so it's like a CDP model.
Yes.
Okay, and then why do CDP creators, why are they willing to borrow something that is going to appreciate relative to the dollar when they could borrow dollars instead?
They could do that, but they have inflation protection associated with it. And what we're trying to hope is that we'll build out lending capabilities associated with the Nuon. So it's like a TIPS. You've got inflation protection on the Nuon itself, which then you can use as collateral, which is stable because you've got the peg price. And at the same time, it's appreciating based on inflation. So you have the inflation protection on there. And you could borrow against that, or you could then drive swaps or derivative exchanges associated with it.
I didn't quite understand that code, because it seems like with inflation, the borrowers always win because the debt they have to pay back later is worth less. So it seems like if I'm creating a CDP and borrowing, I would always prefer to borrow in US dollars than something that's compared to something that's inflation protected, where if there's lots of inflation, I'll have to pay back more than if I had borrowed in dollars. That's the question I'm getting at. And it sounds like you do have a mechanistic answer, but I just couldn't quite follow how it works.
Yeah, no, I mean, so your collateral is earning yield. They're in Aave pools, so they're earning yields on Aave farms. But if inflation hits 10%, you're right, then you're likely to see the repayment requirements grow faster unless crypto picks up faster. You're likely to see your repayment requirements be higher. But that's where we built out the capability to trade it directly. So you don't need to actually mint, you can buy it on the market itself. And those that mint, they also are receiving rewards from the protocol revenue as well. So protocol fees then provide a reward, and those include liquidations that are in those collaterals themselves.
Yeah, at some point they'll probably match the interest rate that expected inflation will match the interest rate that you would borrow DAI versus Nuon. So if they're matched, then it's just like, do you want to short inflation or not? And that's it. Like just the same way as TIPS. Like the government borrows against TIPS, but the interest rate in order to borrow is usually adjusted for expected inflation. So I don't think Nuon would have that problem. It's just if the expected inflation is very high, they might have a problem and the interest rate is not as high. They might have a problem that they would need to run a negative interest rate. But then as someone mentioned at the last podcast, it might be a good solution in those situations. But if expected inflation is 2-3% and the interest rate is higher than that, then there will be any problem. Like current interest rate is 0% on Nuon, is that correct?
It's 0%.
Right. So at the moment, with expected inflation, might be okay, but it depends on the actor.
And when you're talking about the interest rate, where is that interest rate? Like, who's that rate being paid to?
So essentially, you want to compare borrowing US dollar. So probably DAI, right? If I want to borrow DAI, what's the interest rate on that? If I deposit Ethereum, probably at the moment, I'm not sure, 5%. Expect maybe it's more. But then it would match with expected inflation. If expectation.
So yeah, when you mint Nuon, you don't pay any interest rate. There's no borrowing fee for borrowing Nuon.
Okay. But then if there was a negative rate, where is that money coming from to pay the borrowers?
From a pool. So we have a special pool designated for the revenues that hold back some of the money. We haven't deployed negative interest rates yet. That was a recommendation.
All right.
It's just an idea.
Thank you for the long-winded introduction. I feel like I understand now.
Hey, yeah, I'm kind of different than these guys here. I basically lead the blockchain research team at Coinbase currently, and have been focusing on everything on-chain data related. So every time Coinbase onboards a new chain or we try to integrate new chains into our protocols, we take care of understanding what's happening on that chain and see how users are actually using these products on-chain. So specifically focusing on the on-chain data perspective. So especially with stable coins, that's one of the biggest trends we've been focusing on is where are they being used today? Which chains, which layers, who are actually using them, what kinds of users are using them, and how can we grow usage of crypto as a whole using stablecoins as kind of an entry gateway.
Since you have the mic, could you just kind of expand upon that a little bit? Like, what are you seeing on chain in terms of user behavior for stablecoins?
Yeah, it's interesting in the sense of, first, the biggest trend we've seen this year has been, I'm sure folks in crypto are aware, there's a big migration of liquidity to layer 2s from Ethereum and from other blockchains as well. Part of this, of course, is there's just kind of pool of capital that flows to different layers just in the hope of getting airdrops. But even discounting for that, we've seen kind of some actual real usage in terms of flow of capital, mainly driven by pools of liquidity available to do trades in, to do activities in, and more specifically applications that are not just DeFi native, but novel applications. So one particular one we spoke about earlier has been games and decentralized gambling platforms. So this is a fact that folks may not know, but one of the largest holders of stablecoins in all of crypto today is this entity called Staked US, which is basically a platform where you can bet on sports scores, right? So some sort of application that incentivizes real usage from crypto natives and from external participants as well to have fun and potentially speculate on volatility, right? So of various outcomes.
Thank you very much for that, Sid. And I'm jumping around a little bit, but Nevin, I think it would be really nice if you could expand a little bit more on the role that RSR plays in the reserve ecosystem, and like kind of, if you don't mind providing just like one more layer of depth with regards to the reserve protocol in that regard.
Yeah, sure. Okay, so again, with the reserve protocol, you can create a token that's backed, it's issuable and redeemable for whatever basket has been defined. So let's say that's some part gold, some part dollars, and some part Apple stock or something. Now, if any one of those tokens has a dislocation from what it's supposed to represent, so let's say the gold token is supposed to be worth like 1 ounce of gold, and the gold token issuer lost some gold. Now it's only worth half an ounce of gold. There's a mechanism that's part of the reserve protocol that I think is pretty cool, which is that basically there's an excess pool of capital that can be seized in order to make up for that and try to make it so that the stablecoin holders don't take a loss. And so the way that that works, the reason why you can have this excess pool of capital is that if the assets that back the token are being lent out, like over collateralized on-chain loans via Compound or Aave, they can be generating some yield. So the stablecoin itself can sort of be making money along the way. And part of that money can be paid in an ongoing way to stakers, basically people who put up their capital, and they get a stream of income for putting their capital up. But in exchange, if one of these shortfalls occurs, their capital can be seized to make up for that. Okay? And so the way that it works in the reserve protocol is we sort of combine that function with governance. So you can stake your reserve rights tokens, RSR, which is the governance token in the protocol. That makes it available for this eventuality. It can be seized to cover those shortfalls. But also, if you've staked your tokens on a particular R token, one of these stablecoins, then by default, you can participate in the governance of that R token. So you sort of have skin in the game. You want to make sure to have an evolving basket that's never going to default so that you don't actually lose the money because you sort of have the first loss capital. I guess one final thought on that is that in the long term, a lot of this we see as a governance challenge, is like, how should these decentralized governance mechanisms work? If we're governing, hundreds of billions or even trillions in value eventually in the success scenario, creating like a non-fiat based world reserve currency, simple token voting, like really? Probably not. And so our approach to that is basically to make it so that any R token can have any governance mechanism that the creator desires. So it's super easy to deploy an R token. You can like go to a website and like fill in some values and literally do it in 5 minutes. You kind of want to think about those values, so hopefully more than 5 minutes. But it's super easy to do that. But you also, if you wanted to, can create any sort of governance contract you want that controls the R token with whatever logic and like voting polity that you envision. And so we hope that if R tokens start to get popular, people will try many different governance mechanisms. Like this is meant to be in the success case, this could, over the next 5 years, could be like one of the most active test beds for different forms of decentralized governance in all of crypto. And then whatever works can be reused with other applications as well. And the reserve rights token is basically this available governing population. But you could even create an R token that's not governed by the RSR stakers. It could have some other mechanism if you wanted to. So yeah, that's how it works.
Thank you.
Yep.
So one of the goals for this panel is to help everyone who's here to have a better understanding of all the protocols and the different approaches. So before, I'm going to do something a little different. So before we go into like the current regulatory and expected future regulatory environment for these types of projects, I'd like to open up the floor for any clarifying questions that anybody might have with regards to any three of the protocols that were discussed. Does anybody have any questions with regards to like how ISK works, how Reserve works, or how Nuon works? No takers, that's fine. So, so next, oh yes, oh please.
For the treasury that for the first two guys, I can't remember your names. I'm sorry.
Richard and Evan.
Thank you. So for Evan, for reserve, the mechanism for, let's say, rebalancing or changing the structure of the treasury that backs an asset is clear. It's through governance, and there's a big experiment there. But for Richard,
how does the rebalancing works?
Yeah, is that an option?
Yeah,
and
essentially we for now, like we're still setting up our governance, and we're quite open to feedback. But like the idea is that we want our population to be able to vote towards a new portfolio, but we set a rebalancing mechanism that is very slow. So even if, for example, the governance goes completely haywire, they're like, yeah, everything should be backed by Bitcoin, and they go 100% Bitcoin. And then people who are currently holding the ISC token, they have more than 100 days to sell their token and move out, because we're rebalancing 1% per day, essentially, of the difference of where we are currently and where we want to be. So if currently our portfolio is 20% of each asset, of course those assets goes up and down in value. So we're also rebalancing 1% of this difference, which is currently very small because those assets don't move that much. But if there was a vote to change that, then we'll also walk very slowly towards that goal. But eventually we'll reach that goal. If like it's a change that's very good, then people will stay. If it's a change that's very bad, then everyone will abandon ISC and maybe someone else starts a new one. But essentially the governance token will lose all its value because now it's governing a token as everyone left. So that's what we're relying on. It's like we're kind of like Reserve, but a very, very specific token, and we're kind of betting that this governance will work. But if this one does not work, we don't want the holder of the ISC token to lose any value. That's, for us, that's a priority. If the system as a whole fail and so on, that's okay. But the holder of the stable coin should not lose. I think that Reserve has the same mindset with their RSR acting as an insurance, essentially. That the important thing is that the holder of the currency does not have to worry about their value that's supposed to be represented.
Thank you.
Very much. Richard, when you talk about having this portfolio of different stocks, bonds, commodities, gold, etc., who's actually setting the standard of what goes into those? Which stock markets, which bond markets, which treasuries from which countries? What are the weightings? Like how often does that get decided, and how often does that sort of change and get managed?
Right. So generally, when we speak about what's the portfolio, we're kind of very general, global stock, right? The actual portfolio is very specific. It's like this ETF, very, very specific. And when we rebalance, like let's say the governance wants to change the ETF and so on, they will also specify exactly which ETF they want to. So we could essentially, especially as more and more assets move to on-chain, we could essentially, hey, never mind the ETF, we have now this asset on chain. That's what we're going to use, much more transparent. We're kind of also waiting for assets to be on chain, but we wanted to launch in the meantime, there's going to be a very long transitionary period. We want to be live from day one while assets are not yet on chain. But yeah, we quite at the moment it was us, the initial thing. But yeah, the DAO will essentially, when they decide to to set a new portfolio, they will specify which ETF or exactly which asset they want. We might eventually allow multiple assets to represent one asset, so multiple global stock ETF could work, but at the moment it's very specific. It's one ETF. Yeah.
I actually have a question for Nuon, which is like I'd like to understand a little bit more your thoughts about the scalability of Nuon and how you might do that with the collateral that you have available to you.
Yeah, I mean, so at the moment, the collateral is limited to only digital assets and non-fiat currency pegged assets. So we consciously stayed away from USDC. And part of the main reason was solely the depeg that happened, right? When they freeze a bank account, then you just see what happens, right? And so if that could ever happen again, it's unlikely to happen. Although if you look at multi-chain as an example, an individual goes to jail and then all the reserves disappear. But that's less likely to happen in sort of decentralized protocols. And so the way we want to grow that is there are two strategies that we have around that. One is working on being able to allow individuals on different chains to provide collateral. So if you have assets on one chain, rather than bridging it across and figuring out how to use it, how do I leverage those assets on that chain and then mint Nuon? How do we ensure all of that? How do we make that work? That's not a process that's going to happen overnight, but we're trying to test that across two different chains. And then adding new digital assets to the collateral hub. Those are the angles and strategies that we have at the moment.
I have a follow-up. I mean, with digital assets, especially with yielding digital assets, isn't the yield rate, the stability of the currency dependent upon yield being somewhat sustainable, right? I mean, yield is what drives a lot of crypto today, which is like, greed, right? People wanting to leverage, right? And borrowing, right? So how do you see that playing out with variable levels of yield?
So ideally, we want to generate revenue and then provide that revenue back to those people that are providing the collateral, right? So there's a financial incentive and a financial reward to do that. As we mentioned earlier, we don't charge for the actual minting or borrowing of Nuon itself. And then ultimately, where are the yield opportunities with Nuon and what could you do with that is attractive enough either to purchase it on the market or to actually mint it itself directly. On the yield-bearing assets in the collateral hub, yeah, we haven't looked at that really yet. We're just looking to ensure that we can bring a minimal yield. How can we be more aggressive? What other yield opportunities do we have with collateral? And how do we do that all on a non-custodial basis? We don't want to be responsible for the reserve. We want it to be as non-custodial as possible. At the moment, we're running at about 130, 140% over collateralization. So, well, how do we, that's still pretty inefficient. How do we get maybe not to a Terra level, but more at a Frax level where we're sort of 80% with exogenous.
Exogenous, right. And I think, Nevin, you were really curious to talk today about kind of like different, talk about different types of collateral and also like the intersection of the collateral that we use as well as like the regulation of stablecoins that are collateralized, like let's say by securities, right? So could you expand on some of your thoughts about where we are in terms of the current regulatory environment?
Yes. Okay, so the point I want to make here is just that we've kind of already in this discussion established the idea of what if you had a currency that's backed by, a portfolio of assets like what we already hold to protect our wealth today. The main problem from my perspective there, that like Reserve and ISK are both trying to solve in different ways, is those are all securities, or for the most part, those are securities. And so there's this whole regulatory framework that's been built since, at least in the US, from the US perspective, since 1933. And it's evolved with like this existing tech stack where we didn't have blockchains, so everything was on paper for a while, and then it was in these private databases. Because of that, as far as I can tell, there's this enormous knot of like regulation and like companies that like fill certain roles and the way everything is defined for how securities trading and settlement and custody and so on happens today. And that basically, as far as I can tell, makes it not legal to just tokenize existing. You can't just tokenize Apple stock and then have people trade it on Uniswap. As simple as that would be technologically, like that would have happened, 4 or 5 years ago if it were legally not difficult to do, and probably there'd be significant trading volume. Like it'd be actually pretty useful for the financial world if, if ordinary assets could all just be tokenized and we could like borrow and lend against them, and yeah.
Mirror protocol
No. That's very different. So, the synthetic approach of having, someone takes the long side, someone takes the short side, and you have the synthetic asset that supposedly tracks. I mean, first of all, that was apparently also illegal, and they got sued for doing that. No, they got sued. They got sued. Yeah, Do Kwon got served like on stage at a conference or something. Anyway,
not actually.
Oh, I don't know.
Yeah.
I don't know.
Anyway,
Yeah. Yeah, but anyway, so yeah, I think that approach isn't as good or scalable or safe, but even so, it's probably also illegal today. So we have this problem of like, we could potentially, even forgetting about all this stable currency stuff that we're excited about, we could potentially just, enormously, make the financial markets for the entire world, like all of Forex and all of trading of all assets, just like way more efficient, lower risk a ton by making it so you can do trustless swaps from anyone in the world, self-custody. I mean, you guys have all drunk the Kool-Aid, so you see what I'm saying. The problem is, I think we probably are going to need to convince, at least because the US kind of is the dominant financial regulator, we have to convince US Congress to like change the laws in order to do this. I don't even think it could possibly be that like just regulators, like just the SEC could do rulemakings and sort of clear a path for this. Given the behavior of the SEC, that seems pretty unlikely, maybe some future administration. So I think it's probably a lawmaking process. It feels to me like, I don't know, maybe that takes like 10 years from now. Like, I don't think that that's like a simple thing to do. And yet, think about all of the value that humanity is leaving on the table if we don't allow ourselves to just take our ordinary, boring financial assets and have them as tokens. And so the way that I see this is that like, it's obviously the case that that would be extremely valuable. It's probably illegal today, so there's like statutory change that has to happen. And the other thing is that, crypto market participants are probably not going to think about all of the ways that that's going to go poorly, all of the problems that's going to cause, right? Because they just want to make tons of money, right? And so, but the thing is, there's probably all sorts of bad things that will happen as a result of this as well if we do it. And so basically, I haven't figured out the right path forward here, but I think basically the crypto industry, there needs to be at least a contingent of people that seriously think through all of the problems that will occur. And let me just give you one example. Nations typically don't want foreign nations that are their adversaries to acquire controlling voting shares in like systemically important corporations and then control them from abroad for sort of obvious reasons. And there's laws about this. So you have to report, who, holders of which countries hold your securities in order to prevent, these problems. Well, luckily, that's something that you could solve super easily with smart contracts, right? You could just have it be like, yeah, anyone can have a financial interest, but in order to vote your shares, you have to like prove that you're a citizen of this country, which, anyway, there's actually cool ways to do that, zero knowledge, but that's just one example. Like, I think there's going to be like tons of examples. One other very boring thing is like the markets won't close. So it'll be like a completely different way of life for like everyone in traditional finance. Like maybe that's terrible for all of those people. Maybe they really wouldn't want that. So anyway, my point is just that the main barrier to being able to eventually create, sort of move off of the fiat standard onto the asset-backed currency standard, not just gold, but like the portfolio that we all already hold. I think the main barrier is this like legal challenge that probably requires statutory change. And I think if we're not going to be dicks about it, we need to really think through all of the other consequences and try to find a way to finesse it and do that, so that it actually leads to like a nice, elegant, functioning financial system 20 years from now or something.
But it just taking that analogy though, I mean, I love that, right? But I don't want to wait 10 years. And if you
can
look
find
at
a faster way, I'm open to it, but I just don't see it.
But if you look at the fiat world, right, it has its crashes every 10 years, right? It really goes up and then it comes down rock hard, and it's getting bigger and bigger each of these cycles. Is that not also a learning of experimentation, new products being developed, new loopholes being discovered? Shouldn't we in the crypto world also be trying to experiment at the cost? There's going to be some cost associated with it, but the rewards can outweigh the costs.
Yeah, it's just like, you know, if law gets made in response to crises, then, I mean, I think that's often the only way it gets made, unfortunately. But like, you know, if we can make a law because of opportunity and because of envisioned possible future crisis, maybe we'll have more time to think it through. This is kind of happening with AI right now. You know, lawmakers are actually starting to think through what should the laws be, even though there's not really a crisis impending. Whereas like the securities laws, you know, in 1933 was passed because of the stock market crash that led to the Great Depression. So it was like, oh my God, we have to fix this. So I think if we just kind of push the envelope and like, you know, let things like UST happen over and over again and FTX and whatever, and then like make laws to prevent things, it's like, I don't know. I just worry that that could go poorly.
I went to Korea blockchain, like literally was a month after Terra blew up. And, you know, a lot of us, maybe not all of us, but a lot of, especially Koreans, lost a hell of a lot of money in Terra Luna's blow up. And but the momentum, the energy at Korea Blockchain Week, 1 month after that blow up, was so strong. I got to go back to work. I got to work hard. I got to now find what's the next opportunity. What do I need to build? How do I maybe build something new that's not necessarily legal, but how can I find new investors? What's the next board aid to invest in, right? But it was just that momentum, that positive energy that was so, I mean, I couldn't believe, I mean, you just couldn't believe it after 1 month after Terra. And the rest of the West was super depressed. We were all worried. We lost all our assets. What are we going to do? Where do we got to go? And anyway.
Yeah, I mean, I think blockchain is a little bit similar to the internet. For better or worse, there's going to be great things that's going to use the internet. It's going to be great things that are going to use blockchain. I think it's going to be much more efficient. But of course, there's going to be like side effect to that, like there was side effect to the internet. The same way I think blockchain is unstoppable, like the internet was unstoppable. It's something that we kind of are forced to embrace. It's something that the regulator, the countries will be forced to embrace at some point. And in the meantime, I think we don't really have a choice. If we want to innovate and I'd say change things, I'd say we need to adopt the Airbnb or the Uber approach. If they constantly ask, is this legal? Can I offer ride services in cities and so on? They would have been told no. But because they already launched and they kind of right at the border of like, is this, it's a question like, well, they're not technically on the side of the road offering ride services, therefore they should be allowed to. Very clearly the regulator had to like, oh, that's like competing with taxi and so on. There was reason 100 years ago why there was taxi regulation and so on, but those were outdated. And now we have ride hail sharing, which is much better than whatever taxi offered. And that's good. And they had to move quickly though, in order to, okay, that's good, but it needs maybe to be regulated, or maybe don't need the regulation anymore and everybody offer ride hail sharing, and finally we get rid of taxi regulation, maybe. Same thing with Airbnb and hotel, or maybe they coexist together. But if they always ask, oh, we're gonna wait until it's 100% clean and like the regulator says, yes, you can do it that way, then you're never gonna have an Airbnb or Uber. And same, I think, for fiat, like a currency that's not necessarily fiat currency. Maybe a government could do it actually and pull it off, because a government could not shut down another government from launching such a currency. Maybe that's how it's gonna go. I'm not sure.
So just expanding on that a little bit, it reminds me of a story that I once heard from Nevin, which is about the first Coinbase employee who was approached by the regulators, and the regulators said to Coinbase, we don't really like this Bitcoin thing, so could you please shut it off? And so Coinbase had to patiently explain to the regulators that no, in fact, they could not shut down Bitcoin. You know, I just kind of want to, I can see that in this panel, there are two very different points of view. And I actually think that both approaches are very important to get to the place where we want to go. You have Nevin's approach, which is to work with regulators and also Congress and lobby or advocate for a particular position, where also there's this possibility where you could force the regulators to capitulate because you become too big to F with, right? So I'd love to get your thoughts on like kind of the wisdom of either approach and like kind of how you feel about that.
Yeah, I mean, I actually think that the approach that you're taking is an interesting one to do that. So quick elaboration, like, well, I don't think I can do it justice. I don't think I can explain it yet. But like, I guess what I would say is, if there's a way to operate like Uber, that means that the thing you're doing is mostly legal. And like, maybe there's a few questions here and there. But if we're talking about, you know, like, oh, let's just tokenize Apple stock right now, it's just probably going to be unambiguously not legal, right? So I think that, yeah, I think the approach that the general spirit of what you're talking about, if that can be found, I think it's just more ambiguous in this case because of how regulated financial markets already are. Whether there's a way to do something like this that is pretty sure where it's legal mostly, and then have it get really big, and then have regulators sort of like fix things around the edges, yeah, that could be fine. So I hope someone figures out how to do that. Maybe one of these two approaches is going to do that.
Well, I mean, just my argument and my experience with regulators is you give them a tiny little finger, a digit on the finger, they take the whole arm and the whole body. And if you look at Coinbase as an example, they were officially licensed. They went through the whole route. They got legitimized, and they listed, all approved by the SEC. And then all of a sudden, they still get slapped on the hands. And arguably, they were using a law that was written in 1933, and it was an individual that was really driving that. And Congress is, I think, aware that that's not a timely piece of paper to reference anymore. And so I do hope that the regulators come around, because there's no way we are ever going to get traditional finance and institutional money into this industry if we don't have a legal framework that they can rely on. I 100% agree. I do think, though, that the point around Uber, Amazon didn't go and ask Barnes & Noble, we want to come and compete against you. Netflix didn't go to Blockbuster and say, we're going to come and compete. How can we compete against you? Can you give me a framework how to come after your movie business? We don't do that. That's not what disruption is really about. It says it in the word. We're here to disrupt your business. We're disrupting the central banking industry business. We're disrupting the financial services industry. These industries are ginormous. They're quadrillions, as Sergey puts it in his presentations, right? They manage derivatives, our pensions, our healthcare, everything. So how do we do that? How do we do that in the framework without asking them for permission to go down that path? And to me, that I think is the exciting thing. That's why I'm here, because I love doing that, because I'm fed up with these 1933-year-old rules that is supposed to dictate how we live in a life of mobile phones and electricity's everywhere. You know, we actually have lights working here. We have a fan, a ventilator. You know, we have stuff that actually works today. In 1933, I don't think every household had a fan, had light bulbs, you know. Anyway.
Yeah, I think like to kind of also with this discussion, to frame it a bit, we're all talking from a very US-centric point of view. Like, you know, we are sitting in France, and you know, there's a whole world out there, you know, that's not the US, right? And that's something we've been seeing from the data perspective as well, is just P2P transfers on-chain using stablecoins in regions that are not the US, you know, especially with the case of flat coins, where currencies could actually be of help, right, with high inflationary rates. We've seen, especially in South America, South America and Southeast Asia, usage tremendously rise over 2023, which is a significant trend, following on from the trend of dApps like Axie Infinity and things like that.
So do you like track the transactions being submitted to the chain, and you can figure out where they're coming from?
Not all. Yeah, there's just the types of services they use, the types of services that they, you know, route to, etc. just observing the chain activity. So, and especially on cheap chains like Polygon and where their fees aren't that high, seeing these stablecoin flows is pretty encouraging to see. And like that's the kind of more tied with your Uber example, right? If you can get a real life service to actually catch fire in these countries and be a real utility, hopefully we have a global wave that's not just US centric. We're not all just waiting on that, right?
So on a related question, because Stefan, you mentioned that the current financial markets is trillions and trillions of dollars, and you're right, and it's interweaved into everything that we do. And what you said there, Sid, about stablecoins and their utility. How do you see the future of these really interesting non-fiat backed stablecoins in the next 5 to 10 years? How will they be used? I mean, how will you replace a multi-trillion-dollar financial system? And do you see them coexisting? I mean, obviously they will coexist. I can't. But
so governments are launching CBDCs, right? We see that as actually being a super big industry in the next 3 years. That's going to be at least if the market stays the same, it's going to be a $300 billion industry in the matter of no time. Why? Because they have the distribution. And they still have, yeah, exactly. I mean, anyway, yeah, but I mean, I think stablecoins will work out. So what I'm trying to say is it will work alongside those fiat currencies. I mean, CBDC, it may not even be on a blockchain. I don't even know if they're on a blockchain. They're just called CBDCs. but
So I don't think it's a liquidity problem that more than like who's going to accept this and why would they accept it if nobody else accept it yet. I think we're going to need a glue that is essentially a very easy way for retail to exchange my currency into your currency. It might be USDC, and maybe the whole world still use USD. But I use my own currency, and then I onboard someone else, and then we use a better currency. And then over time, we can convince more and more people to come in. But without that glue, and I think blockchain is it's fairly easy to build that glue. Like the only glue that we're missing right now is like, or that's not like very, very good is to go back to the normal world, the fiat world, right? So I can send someone ISC and they can exchange it for USDC very quickly and then send it forward. So that can all be done on chain very easily. But it's going to be hard to pay for coffee because they're not on chain. They need a fiat processor, and that a lot of people are working on that. But that still like needs to be like there's a lot of work that needs to be done there. It's very hard compared to credit card to use crypto still. I don't feel safe. I wouldn't want my mother to use crypto even though it would be great. She could send me money very easily. It's like, no, it's fine. Like just go to the bank, wire money or accept my wire. Like much easier, much safer. Sure, it's $50, but like people are solving that. Yeah, I know.
But it's harder to send money to a bank than it is using a crypto wallet. I don't think people realize. Everybody says, oh, it's too hard. My mother will never use a wallet. Bullshit. It's harder to send. I have to go, I've got bank accounts around the world. I can hardly send money between my own bank. Well, that's so possible. I'll solve that problem. Okay. But actually, I disagree with you. I would want my money to be you would have to know that. Right. And at that point, we reached the credit card. Like, nobody, not nobody, but
99% of people who use credit cards don't know how it works. And that's okay. That's great. I hope crypto eventually reaches that. And stablecoin and fiat platform reaches that. But yeah, a lot of people are working on that.
So one more thing to add in your question of like, how would people actually start using these non-fiat currencies, hypothetically? Like my take on that is that in the sense of like huge mass adoption, I think it's very unlikely to happen as long as the major fiat currencies don't like really unravel. Like as long as they're basically working, people are basically just going to use them. Just thinking about what I could ask your phone to do through the microphone. Yeah. But the thing is, the Reserve Project has some experience. We built a stablecoin wallet that people use in Latin America, substantially in Argentina and Venezuela, where there's high inflation. And in those countries, people don't start off wanting US dollars. They start off wanting their own local currency because that's what they pay for things in. Obviously, it makes sense. But if your currency starts to lose value fast enough, then suddenly you want US dollars is kind of the default thing to switch to. And so we saw quite a lot of adoption of this dollar wallet, particularly in Venezuela, where inflation was the worst. And like thousands of merchants signing up to take payments in US dollars on this like weird newfangled platform. Which, like, if you go to any city here in France and try to sign them up to accept the digital stablecoin euro, they'd be like, why? It doesn't make any sense. And so my basic take is that like if the euro or the dollar like really unravels at some point, you could see demand skyrocket for an alternative. That's something that is proven. It's been around long enough. Some people have used it. It's being used as a store of value or whatever, but hasn't really been used massively as a medium of exchange. So if suddenly everybody wants to hold it instead of holding sort of foreign cash into the mattress, then now you have this huge population of people who are holding this thing, and it's more convenient to just transact in it directly. So I think that if we see, I think the scenario where we really, as a world, switch from the fiat standard to asset-backed currencies of some form is a world where it's really in response to some massive crisis. Well, I mean, it seems like with currencies and financial products generally, because it's so valuable to use the one that everyone else accepts, and because with financial products it's hard to understand them and you end up generally following the crowd unless you're like a huge institution making early decisions, I think that would end up just being like a snowball and kind of a power law where there's like one that's like most popular by far, and then there's like a second that's still used in like some countries, and then like maybe a long tail of like ones that are used on the side more as investment products or whatever. How that competition goes and which one gets selected, I think is, a feature of, just market competition. Yeah. I think so. Yeah, I imagine being a sort of power law situation.
It's so far down.
Yeah.
I mean, at the moment, the dollar.
Please.
Realistically, something China, by the way, pegs to the US dollar, so there's already a bit of an issue there. And then Russia, I don't know what the world is ready to accept the ruble. And I think one will take all, but in order to actually disrupt and change a non-fiat currency in some form, and maybe even not a dollar, it's going to take an aggregate movement to Bitcoin really dollars. By the way, in Europe, there were more than 10,000 stores run in Europe that using that store for coffee. I was in Europe the other day. I went to crypto. Slovenia, I know for a fact that we saw over 6,000 distributors crypto in the Philippines. These are actually the AFS is the de-facto currency when you go to the fresh food market. It is actually happening. I think it's not necessarily in the traditional
it could be broken down by locality too. Like it could be geographical locality or just community. Some community prefer that. But the advantage of crypto again, it's going to be so easy to change from one to the other that it's not going to necessarily always converge to a one rule all. But it might be one that's a major one, like the USD, and then there's a bunch of other currency that are working very well.
I used to have one question, but now I have two. It's okay. Okay. After the discussion. The first one is about Argentina, Venezuela, about the adoption of stable coins. So I know in Argentina people are perceiving it as same as US dollars and they are looking for US dollars. But there are also many other countries like Turkey, Egypt, even if the adoption is Turkey is higher, they don't see it same as paper dollars. They are still saying this is, this is a Fiat, it's not the same thing. So why do you think, or how does this adoption happen? Because they don't have access to paper dollars, or what is the motivation here?
So it's a really good question. I think that, well, in Argentina, paper US dollars are ubiquitous, and everyone has access to them. In Venezuela, that wasn't true for a while, and then it became true. But there are, okay, you can't transact paper dollars at a distance, right? So people do have an incentive to use electronic money for that reason. Also, if you're a merchant or a person who's dealing with any amount of money, like once you start to amass a lot of paper dollars, if you're not in a country where you can bank those paper dollars, then that starts to become a logistical problem for you. Mm-hmm. And so I think those basic things end up driving the demand for basically digital dollars. Mm-hmm. And then I think people would by default prefer to just have like an American bank account that they can transact with. If everyone in the world just could have an American bank account, there'd be less demand for stablecoins for sure. The thing that we saw is you have to make it really easy for people to move money in and out, to convert local currency into the stablecoin and back again. And so once we managed to find a way to do that, then we started to see a huge amount of usage because that's obviously the thing you need to do. There's a lot of merchants that don't accept. So we're proud. We got to the point where there's 27,000 merchants in Venezuela where you can pay with our app directly with stablecoins and buy goods and services. Mm-hmm. But then there's countless more where you can't. And so you have to be able to convert back out into the local currency, even if it's hyperinflationary. If you convert back into it and then you pay 30 seconds later, then you're not worried about the inflation rate. And so if you have enough of that liquidity, which like in Turkey, I think I don't think anyone's built that really in Turkey. I don't think that there's like necessarily the same level of liquidity, and maybe I'm wrong, but
like super early.
Yeah. But I think that could cause a huge amount of adoption of crypto.
Yeah, thank you. Second one is super short about actually research. Do you publish it somewhere? Because chain analysis report is great, but it's not focusing on stable coins. I'm looking at Google Trends data. It's telling a lot actually about Tether usage, etc. This is the only resource. But do you publish Coinbase research somewhere?
Yeah, happy to send you the link. We just published last week actually. So,
oh, really?
Yeah,
amazing.
Yeah.
We have about 3 more minutes. So I saw there were like 1, 2, 3, like a lot of questions here. So if you could just try to time limit your answers, I think we can get through all the questions. So yeah, I think this gentleman actually had his hand up first. So.
Thanks. All right, so you guys know there's a problem that needs to be solved, and presumably everyone else here knows there's a problem. And in Venezuela, people out of desperation know there's a problem. I have friends in Argentina that go to the store, and they don't know if they're paying the right price because it's double what it was a week ago, and they don't know if it's the store or the whole economy or what. What are you guys doing, or who are you partnering with that's letting people know they have a problem that can be solved or that needs to be solved? Like some people are discovering it, but maybe there's some education that's needed. Are you guys thinking about that?
I can start. From at least from the Coinbase perspective, we're trying to go live with Base, which is layer 2. The big goal there is to bring the next billion users on chain, and a large part of that is just education. Like how do you use basic on chain activities? How do you use a wallet? Bring them on for very cheap transaction fees, and then try to have them use products like these guys over here, and potentially just get them on board with crypto, right? And a large part of that is education. So that's the goal with Base. I mean, it's global, of course, but the focus is to bring people who aren't on chain at all on chain. Their first interactions hopefully happen via Base, and like, you know, slowly start to grow from there. So there's a big crypto native audience, which, you know, potentially a lot of folks here target. You know, there's $1 trillion of market cap in crypto to target, but there's so much more outside, right? And so we want to bring that on board slowly. Yeah, absolutely. So that's one of the big initiatives we want to see built on Base, right? And you know, so it's one of the 4 requests for projects that we're trying to have on Base, where you know, inflation is a big issue, right? And while there are ETFs and other products that address that, if we can have a crypto native way to address that, fully crypto native, transparently on chain, where we can audit it. We spoke about this earlier. You know, the beauty of the blockchain is that you can be transparent. Anyone in the world can see how this monetary system is run. And if you can see that algorithmically and verify the math for that, and people can understand it, like you said, it's a bit complicated at the moment, but if we can make people understand it, that's huge. That's the goal, right?
Yeah, so I guess I wanted to get your comments on 2 things. So one is, what do you think of like non-US jurisdictions? Because, so I come from Singapore, right? And there, I think the regulations are much more aligned with like what works, like what's useful to us as a country. We're not so protectionist because we're very trade dependent, and we're very open. We've got a huge commodities market and a huge FX market, right? So what do you think about experiments in regions outside the US, in strong financial centers beyond the US? And also I want to get your thoughts on like use cases, kind of going back to the point about Uber. So Request Finance focuses specifically on global payroll. We're not as big as some other players, but we've done over $350 million in payroll. So what do you think about other use cases that are non-speculative to drive the adoption of stablecoins?
I think non-US experimentation is a great idea. One practical idea for how to enable that is these days you can, all passports are like digitally signed by the nation that issues them. And so you can scan them with like, I think it's like an NFC reader. And it's possible then to create a zero knowledge proof proving which country you're from without any other information about you. Or potentially, I think you could probably make one just proving that you're not from the US. So you could have basically a standard, like a token standard, where there's like a whitelist that's maintained by some company would have to pay to do this, or people would have to pay to do it or whatever. And then if you just have sort of the non-US crypto population validated on chain, because the issue is if you issue some product that's supposed to be for non-US users, but it's on chain, there's really no way to screen out US users without, like, if you have some heavy KYC process, and then it's like, no one wants to touch that. So if you had a super light way for people to not identify themselves, but just prove that they're not a US person, and then be part of this enormous non-US DeFi ecosystem, then you could potentially enable a lot of experimentation. Maybe you could also have, just the Singapore population, albeit it's a smaller one, but maybe there's a family of 10 countries together or something that could have their own sort of DeFi ecosystem. Part of me hates this. I'm like, no, I don't want any discrimination on chain. I don't like that path in a way. But maybe that's a way to do that sort of Uber type example where it gets really big and it's obviously really valuable before it can sort of be stopped on a global level, and then maybe the USs of the world have to adopt it.
Yeah. Man, I feel like we could go for like another 30 minutes or an hour, but unfortunately our time is up. Can we give all the panelists a round of applause? Again, thank you so much for joining. I know that this gentleman had a question. We can talk outside. And before we go, I'd like to show Sid. Sid's going to be giving a talk, right? What time is that talk?
Soon. Yeah, I think 4:30, something like that. Yeah.
I have never seen better on-chain like user behavior analysis, except for like the stuff that comes out of this gentleman's mouth. So please attend that talk. It's very, very good. Thank you very much for your time.